Hi, welcome to Dig into China. I'm Dong Sheng. On the September 4th episode, I mentioned that China's central bank has started buying and selling government bonds, a tactic to inject liquidity by expanding the money supply. This move suggests that China might further increase liquidity in the future. In fact, boosting liquidity has become routine in China. Over the years, the central bank has used various methods both openly and subtly, such as cutting reserve requirements and lowering interest rates to provide liquidity. But why the relentless drive to release liquidity and inject money? The underlying reason is that China's economy is facing serious challenges. China's economy is essentially facing internal deflation. Consumer demand is severely weak, with no way to stimulate consumption or generate domestic demand. So, what's the solution? From a financial standpoint, the only option is to keep issuing currency and injecting liquidity. However, it's important to recognize that these liquidity measures will inevitably have an impact. Internally, aside from the potential flood-like consequences, there will also be spillover effects on the global stage. The liquidity China is releasing will undoubtedly flow into neighboring countries and throughout Asia. Taking a broader view, it's clear that the stagflation and the deflation are not solely China's issues. They are affecting the entire region. Deflation and stagflation have become common across Asia. As a result, the crisis may first unfold in China, but it could ultimately trigger stagflation and a broader economic crisis across Asia. China's economy is intricately linked to the rest of Asia, with both being closely interconnected. Today, I'll explore the dynamics of this relationship. After 2000, China's central bank issued currency primarily through foreign exchange reserves, using US dollar earnings from trade as the foundation. But since 2013, the central bank has introduced various short-term policy tools, such as reverse repos and different forms of medium-term lending facilities (MLF). Now a new tool has been introduced to the toolbox. What does this trend signify? These policy tools highlight the growing control China's central bank has over liquidity management. During the era of foreign exchange reserves, currency issuance in China was largely passive. Over time, the central bank introduced a range of monetary policy tools to gain more autonomy in currency issuance. Today, that shift is essentially complete. Moving forward, the central bank will have even fewer restrictions, allowing it to inject liquidity with greater freedom and flexibility. The central bank only injects base money, which is used to strengthen liquidity among financial institutions. This base money then multiplies through the money multiplier effect, creating broader money supply. Consequently, market liquidity grows exponentially beyond initial base money issued. China's central bank is increasing liquidity because the economy is rapidly deteriorating. This situation requires the central bank to use every possible method to support the market, including injecting base money, lowering reserve requirements, cutting interest rates, and utilizing all available tools. As I mentioned in the previous episode, local governments in China have adopted a slashing parts to sell scrap metal economic model, reflecting the severe downturn and the current period of unprecedented economic stagnation. In this challenging environment, the central bank, as the regulatory authority, can only do so much within its role, primarily to keep injecting liquidity to stimulate the economy. Will these monetary measures and economic stimuli be effective? The answer is they might have some effect in the short term. However, will these stimulus measures have the same impact as before? The answer is no. It's essential to consider the broader context. The 4 trillion yuan stimulus plan launched in 2009 was during a period of significant domestic optimism about the future. Although the world has just faced the subprime mortgage crisis and economic downturn, globalization was still in progress. China had recently hosted the Olympics, and few believed that globalization would halt or that China would reverse its reform and opening up policies. At that time, Xi Jinping had not yet taken office, and the people generally remained hopeful about the future. While the 4 trillion yuan infrastructure plan did have major side effects, it managed to keep the Chinese economy going for over a decade. However, by 2024, with Xi Jinping in its 3rd term, both global and domestic confidence in the Chinese economy have been shattered. In this scenario, despite using similar monetary and fiscal measures, the situation is different. It's akin to applying the same treatment to a patient whose pulse has long since vanished. Thus, strategies that were effective in the past are now largely ineffective. Given the current situation, even spending 40 trillion yuan won't make much of a difference. The effectiveness of economic policy tools has reached an all-time low. While there is a pretense of trying to revive the economy, everyone knows the reality. The patient is beyond saving. You can't use a defibrillator to bring someone back to life if they are already dead. Consequently, all stimulus measures end up being a fruitless endeavor. At this juncture, we should consider an important question. If a country's regulatory authority or central bank implements stimulus policies that create economic bubbles, such as the real estate bubble in China, does that mean the stimulus is successful or not? I can say plainly, if the stimulus results in asset bubbles, it at least means that the stimulus has been effective. Using the real estate bubble as an example, although there are many drawbacks, it can stimulate a range of related industries. Property construction can boost the local economy and generate employment across various sectors. However, it also exacerbates wealth inequality, social injustice, and other serious problems. In other words, while China's 4 trillion yuan policy resulted in considerable social inequality and widened the wealth gap, it also ensured that China were able to eat and avoid starvation in the years that followed. This suggests that, at least in terms of preventing severe economic hardship, the policy was successful. Here, I want to address a significant issue: the sorrow of the Chinese people. In China, individuals frequently find themselves choosing between the worst option and the second worst. In this context, the second worst option can appear as a relative blessing, a much better alternative compared to the worst. In China, the choice often boils down to either experiencing bubbles or facing starvation. There is no real alternative. This is indeed tragic. Even more distressing is that the new monetary tools and the liquidity injections might not generate those bubbles at all. Instead, they could have no significant impact, only causing spillover effects that affect neighboring regions. Let's explore what spillover effects entail. Spillover reflects to the outward spread of impact, similar to how water spills over and affects its surroundings. In the context of China's economic policies, spillover means that these policies can have effects outside of China. These effects are often unforeseen and were not part of the original considerations by the policymakers. The main spillover effect of China's monetary policy is that excessive money injection inevitably leads to capital flowing out of the country. This becomes particularly pronounced when there are limited investment opportunities within China. As liquidity increases, more funds tend to move abroad. However, the Chinese government does not desire this spillover effect. It aims to keep all capital within the country and encourage long-term investments in mainland China. To this end, the concept of patient capital has been introduced, which emphasizes a long-term investment. On July 9th, the People's Daily published an article promoting patient capital to drive innovation. The article described the patient capital as focusing on long-term projects and investments rather than short-term gains, with a strong tolerance for risk. The government seeks to use regulatory measures to discourage the pursuit of quick profits and short-term gains, aiming to transform highly liquid capital into less liquid, patient capital. However, whether this approach will truly foster long-term investment in China or have the opposite effect, it is still uncertain. We shouldn't overlook that alongside the introduction of patient capital, another slogan has emerged: smash parts to sell scrap metal, as covered in the previous episode. Connecting these two ideas reveals a concerning underlying message. On one hand, the government aims to use various coercive measures to ensure that the capital remains in the country and is invested long-term. On the other hand, if you become part of this patient capital, you might find yourself subject to the harsh realities implied by the smash parts to sell scrap metal approach. So, any reasonably prudent person would see this as a trap. Patient capital is merely a prelude. Smash parts to sell scrap metal is the real agenda. The goal is to ensure that once capital comes in, it cannot leave, transforming it into something akin to an iron part that can be smashed. Given this situation, no matter how much liquidity financial regulators inject, the capital markets are unlikely to show any improvement in the long term. Chinese capital essentially faces two choices. It can either stay in China, where it risks becoming patient capital subject to the smash parts to sell scrap metal approach, or it can leave China and move abroad. The phenomenon of capital outflow pertains to the second option, where capital leaving China often flows to specific regions, impacting their economies. This is already happening, with significant portions of this capital moving to other Asian countries, especially those neighboring China, such as Japan, South Korea, Singapore, Malaysia, and various Southeast Asian nations. From the perspective of capital flows, these countries benefit from China's economic troubles. The influx of capital from China can improve their economic conditions to some extent. As the saying goes, when China stumbles, neighboring countries thrive. The transfer of industries, capital, and wealthy individuals from China following a decoupling actually benefits these surrounding nations. While it may appear that economic troubles in China benefit its neighboring countries, with worsening conditions in China leading to gains elsewhere, a macro perspective reveals a fundamental convergence among all Asian nations, including China, over the long term. This convergence is driven by a shared issue: population aging. This challenge is not solely a demographic concern, but also an economic one, and it is unaffected by political leadership or the political system. Regardless of its political system, whether democratic or authoritarian, China must confront the issue of population aging. Xi Jinping's leadership has accelerated this change, but it hasn't altered its direction. This challenge is also faced by many other Asian countries, particularly those influenced by Confucian culture, such as Japan, South Korea, Taiwan, and Singapore. Statistics show that in Singapore, over 16% of the population is aged 65 and older, and by 2033, about 50% will be over 50. East Asia in general is experiencing a faster rate of aging compared to other regions. For example, last year, Japan's population aged 65 and above surpassed 29%, while in South Korea the figure was over 18%. Although China's aging process is relatively slower, under Xi Jinping's leadership, the proportion of those aged 65 and over exceeded 15% in 2023. By 2030, China is projected to have 230 million people aged 65 and older, with nearly 80 million of them unable to live independently. Population aging prominently impacts the economy by causing deflation. Older adults generally have lower consumption and investment needs. When both consumption and investment demand decline, deflation is likely to occur. To combat deflation, economic authorities typically implement measures such as increasing the money supply, reducing interest rates, and boosting market liquidity. However, these policy measures fail to address the fundamental issues of declining birth rates and a growing elderly population. Consequently, overall consumption and investment demand remain inadequate. At the same time, with a significant increase in monetary liquidity, the economy faces a paradox. Low demand and a stagnant economic activity combined with rising inflation, leading to a classic case of stagflation. In essence, deflation has turned into stagflation due to extensive monetary expansion and liquidity measures. The transition from deflation to stagflation is largely driven by these liquidity policies. By increasing liquidity to cover up deflation, the government has inadvertently caused stagflation. This issue of policy-induced stagflation extends beyond China, affecting the entire East Asia region, especially countries within the Confucian cultural sphere. On the surface, it appears that while China struggles, neighboring Asian countries are thriving. However, this is merely a short-term effect. When considering a longer timeline, it's clear that all Asian countries face issues related to overall social demand and demographic imbalances. Ultimately, these problems will likely lead to adverse outcomes for the entire region. I have a long-term pessimistic view on emerging markets in Asia. Essentially, unless there are real improvements in overall social demand and demand-side reforms, financial strategies will be ineffective. Without addressing these fundamental issues, economic conditions will not improve and the cycle of deflation and stagflation will continue. This issue affects all Asian countries, not just China. In summary, the Chinese Communist Party wields two primary tools: patient capital and smashing parts to sell scrap metal. When employed together, these strategies ensure that once capital enters China, it cannot escape. Instead, it risks being devalued and discarded. The policies of patient capital and smashing parts to sell scrap metal are likely to have the effect of driving capital away from China as investors seek safer havens. In the short term, this may benefit some neighboring Asian countries, especially the more developed ones, by boosting their capital inflows and providing a temporary economic lift. However, in the long run, the entire Asian region faces common challenges, including an aging population, declining work willingness, and low birth rates. As a result, the region is likely to experience persistent deflation and stagflation. The core of an economy is its people, not the numbers. An economy prospers when individuals or groups are creative, motivated, and have clear goals and unending drive. On the other hand, in regions suffering from population aging, where people lack ambition and motivation, superficial policy measures cannot revitalize the economy. Thank you so much for watching. If you found this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, stay well.